Welcome to the Deep Dive. Today we're taking a closer look at Freeport-McMoRan, that's FCX. It's really shown some, remarkable resilience and transformation. Our mission, as always, is to dig into the key insights from its recent technicals, its financial health, basically give you that quick shortcut to understanding its potential. So, let's get started. All right, FCX. It had quite a long journey, didn't it? Almost a decade, really, from late 2010 right through to August 2020. It was sort of stuck.
Yeah, trapped in that large descending wedge pattern. It was quite defining for that period.
And then it hit that major bottom, January 2016. The price was hovering between, $3.40 and $4.80.
Exactly. And what's fascinating there, really fascinating, is how that range lined up almost perfectly with its all-time low from way back in November 2000.
Wow. Okay, so a true historical demand zone.
Precisely. It wasn't just a random number. It could just, deep-seated institutional belief in its long-term value. It formed this incredibly strong floor, historically speaking, really key to understanding the turnaround that came later.
That makes sense. That deep support really set the stage. And it paid off. August 2020, we finally saw it break out.
Right.
Above that wedge trend line.
Yes, a major breakout. That was the confirmation, really, of a big long-term bullish reversal.
And then that range, the $4.80 to $10 zone, that became a major accumulation area.
Exactly. It's solidified as that accumulation zone.
Yeah.
It'll potentially a really high probability buying spot if the price somehow ever got back down there.
So where are we now? Currently, it's trading near $45.50.
Around there, yeah. And it's holding firmly above the 50 EMA, the exponential moving average, on the monthly chart, which is positive. However, there's always a however, isn't there? The monthly RSI, the relative strength index, it's showing some bearish divergence.
Okay, explain that a bit. What does that mean for people watching?
Well, it basically means that even though the price has been climbing, the strength or momentum behind that climb is actually weakening, at least on this long-term monthly view. It kind of hints the stock might be running out of steam for this particular rally. Think of it like a car still going fast, but maybe the engine's losing a bit of power.
Got it. Now, something interesting happened more recently, right? April 2025. A monthly candle with huge volume.
Yes, ultra high volume. But interestingly, it got rejected near the $28 level.
Rejected.
Yeah.
So a lot of activity, but the price couldn't hold higher. What's the signal there?
Well, that kind of rejection on huge volume is powerful. It suggests a big tussle between buyers and sellers. Institutions were clearly active, very active, but ultimately selling pressure won out around that $28 mark, at least temporarily. This can often signal, maybe some consolidation or even a pullback is coming. If you zoom into the weekly chart, the stock's trading inside an ascending channel, still above its 50-week EMA too. And a new demand zone seems to have formed, roughly $25 to $29.
So that could act as support if it does pull back.
Potentially, yes. On the upside, if things go well, we could see it retest that $55 resistance. And if the momentum really picks up, maybe even a run towards the all-time high near $64.
Okay, but what if it pulls back more seriously? You mentioned that possibility.
Right. That raises the question, doesn't it? What if this current support doesn't hold?
So if the trend really shifts, what's that critical level we should be watching for? The one that signals maybe a deeper value opportunity.
If FCX breaks, and crucially closes below $26 on a daily or weekly basis, well then it might revisit that old long-term wedge breakout zone. We're talking near $14.
$14, wow, okay. That would certainly be a deep value point compared to today.
Absolutely, a significant discount.
Okay, let's shift gears a bit.
Okay.
Beyond the charts, what about the fundamentals? Is there solid substance behind this technical story?
Good question. Connecting it to the bigger picture, Freeport-McMoRan actually looks, potentially undervalued fundamentally, despite the recent run-up.
Really? Even with the stock around $45.80?
Yeah. Some DCF models, discounted cash flow estimates, put its intrinsic value somewhere between $47 and $57. That suggests maybe 5% to 27% upside from current levels.
But what about that PE ratio you mentioned earlier? Around 33 times earnings. That sounds quite high for a materials company, doesn't it? Sector average is closer to 20.
It is high. You're right to flag that. It's definitely elevated compared to the sector. But, and this is important context, you have to look at its financial structure. It's remarkably strong.
How so?
Well, its debt to equity ratio is really conservative, just 0.31, and its current ratio, a measure of liquidity, is robust at 2.4.
Okay, so low debt, plenty of liquidity.
Exactly. That strong balance sheet suggests the market might be willing to pay that premium, especially in a cyclical sector like mining where, financial stability is really highly valued.
Makes sense.
Yeah.
And are the recent earnings and cash flow holding up?
They are. Q1 2025 revenue hit $5.73 billion. That was up year over year. Net income margin is around 7.1%, return on equity near 7%. And importantly, free cash flow stayed robust, about $2.35 billion over the last 12 months, and that's even after significant capital spending, around $4.8 billion. Plus, they pay a dividend, lowered 15 cents per share quarterly.
Okay, so a solid financial footing there. Bringing it all together then, the technicals, the fundamentals, what's the overall outlook? What are analysts saying as of, say, July 2025?
Analyst sentiment seems largely positive. Raymond James trimmed its Q2 EPS estimate slightly, but they kept their outperform rating and a $52 price target. And you see other banks like Deutsche Bank, Jefferies, BMO, they've either maintained or even raised their price targets mostly in the $47 to $54 range with buy or sector outperform ratings.
So generally constructive views from the street?
Generally, yes, aligning somewhat with those intrinsic value estimates we talked about.
Okay, and for our listeners thinking about all this, what are the key risks they should keep front of mind?
Well, the big ones are pretty inherent to the business. Commodity price swings, especially copper prices, that's huge for FCX. And of course, the cyclical nature of the mining sector itself.
Right. Always sensitive to the broader economy.
Exactly. It's just the nature of the beast in this industry. Those are always factors you absolutely have to monitor.
So we've taken quite the deep dive into FCX today, from its really long-term technical journey out of that wedge to its current financial strength, the analyst views, and those inherent risks. It's quite a story. It really makes you think, doesn't it? What stands out to you about how these deep historical chart patterns and the hard numbers of fundamental health can combine to paint such a complete picture of a company's potential? Something to mull over until our next deep dive.